Here with another video. We're still on the energy companies of Germany, and I try to analyze the rest of them. To be honest, I want to finish the entirety of the stocks available for trading on the entire marketplace, because I've been delaying it for too long. So let's just get straight into it. So we need to go on search, then we need to go on browse all. So we have over 9,000 to analyze. That's going to take a lot of time, but I have to get it all done. So Germany, Energy 11. So we're on video number 10. We've done, the last video was on Varta. Now we need to do Verbio. So I'm going to look at the chart, of course, the overall performance. It's 1,693% increase since the start date. We need to look at how much my investment has increased. 49%, which is really good, considering that I've only owned the stock for I think a few months, less than a year. So we're going to look at the key ratios. Market cap 4.43 billion, definitely a large cap stock. Anything over a billion I think is large cap. PE ratio 47, that's pretty high. If you guys are considering or questioning what a high PE ratio is, I think anything over 10 or 15 is high. Revenue 1.03 billion compared to the market cap. I think that's decent. Not decent, sorry, I think that's pretty damn good. It's about a quarter of the market cap. But we need to look at profit margin. That's the most important thing when it comes to revenue. A company can earn a lot of revenue and a little bit of profit. So let's go to earnings per share, 1.48 euros. Let's check the price. So earnings per share is 1.43 euros, but the price is 64 euros. So 1.43 compared to 64 is not great. It's a very tiny percentage. So if you guys are considering what earnings per share means, it's kind of the same as the PE ratio. So you earn, if you're an investor, you need to look at the earnings per share as I'm earning 1.48 euros or 1.5 euros for every $64 I have invested. So let's just say it's going to take you about, so if you want to see how many years it will take you when it comes to looking at the peak price to earnings ratio, you need to look at, so if it's saying 47, it's going to take you about that many years, considering that if you were to look at it as the company earning the same amount every single year, then it will take you about 47 years of those earnings to earn your money back. So let's go back and let's go straight to the income statement. 1.03 billion in revenue for the current financial year. Net income is 93 million. So that's not a great profit margin. It's just under 10%, and 10% is probably the minimum in terms of what I would say a healthy company is, considering that the debt to asset ratio is not too high either. So let's look at the debt to asset ratio. It's 25%, which is not too much. I think it's a decent amount. 25% is actually pretty damn low, but you have to consider how much the profit margin is, under 10%. So the issue with high debt amounts is the interest that has to be paid, even if the company is paying a very low interest rate to the lender. The lowest, even considering the lowest interest that a financial institution would require, it would still be a lot if a company has borrowed billions of euros. So this company's borrowed 170 million euros, and roughly 70 million euros, and the interest on that is going to be quite high. So we need to look at the revenue, the profit margin, which is what the company has left over after paying most of its expenses. The profit margin is 9.08 million, but the actual figure is 93 million, which is the net income. So 93 million, a lot of that is going to be, not a lot, but a chunk of that's going to be wiped out by the interest that the company has to pay on 170 million. So let's say it's about 4% a year, depending on how credit worthy this company is. let's go to the calculator. Let's just say it's about 4% or 5% a year. So 170 million multiplied by 0.05 equals 8.5 million. So the real net income will be 93 million minus 8 million, which is about 85 million. So it's still a decent amount. It's not too much. So 85 million over the market cap, or because the market cap is how much you're going to be paying for the stock. 85 million over 4.43 billion. That's not even really a chunk. That's just barely anything. So you're not really going to be earning much of your money back if you invest in this company. And considering that the net income has been pretty much consistent over the past 3 financial years, except for 2018, which is even worse in terms of net income, the company's not really going to change very much unless they have new management, of course, and the whole structure of the company changes. So let's just say the company is to consistently move forward in the same way it has been the past 4 financial years, which you probably will, you're not really going to make much money on investing in this company unless they've introduced a new product and the people react very positively to the stock. You're not going to make much money as a long-term investor. So let's look at the cash flow statement, which is also very important. Net change in cash overall. By the way, just to let you know, I've already analyzed this company like prior. I've done a bit of practice, so I already know what the cash flow statement is going to suggest. So the net change in cash for the 4 financial years in the past, including the current financial year, is positive. So if you look at this financial year, 51 million positive. The last financial year, 14 million negative, 39 million positive, and 26 million negative. The overall profit, net change in cash, is positive by close to 100 million, which is decent if you look at that compared to, then again, the market cap, which is what you'll be paying. Or let's look at it on the return on the assets, so you can look at return on assets. 678 million, 100 million, that's just about under 25%. I think it's about 20%, maybe less, which is pretty decent. So I think it's 20% return on assets. But if you look at it based on how much you're actually paying for the stock, which will be return on investment, 100 million compared to 4.43 billion, that's barely anything. So I wouldn't really be optimistic about paying for this stock. That's the analysis of Verbio. I hope you guys have enjoyed. I will see you in the next one.